Welcome to TradeSpoon. My name is Vlad Karpel. I'm the founder and CEO of TradeSpoon. And today I'd like to talk about why to trade options. So let's take a look. A lot of people ask me, majority of people do trade stocks and not comfortable with trading options. But options do give you a certain advantage over stock traders. And I think you want to at least learn what advantages of option trading is and then consider augmenting your portfolio with options. If you can create a hedge for your portfolio, or if you can generate steady income by trading options against your underlying stock, you can greatly improve your monthly returns. And let's take a look why. Options allow you cost basis reduction. If you buy in stock like Apple at $135, you can execute an option strategy that instead of buying stock like Apple at $135, you can buy Apple at $130. Anytime you can have a 1, 2, 3% cost basis reduction for the underlying asset that you're trading, that means you're improving the probability of success by greater than 70%. If you trade in stock, it's a binary event. Tomorrow it might be high, tomorrow it might be low. You can do a lot of technical analysis and you can do a lot of fundamental analysis, but at the end of the day, the stock market is a random system of events. You cannot predict random events such as geopolitical events. That means it's like a flip of a coin. It can go up or it can go down, hence 50% probability. With option trading, if you can buy underlying asset such as stock at a reduction of cost basis, if you can buy a stock at a 2 to 3% cost basis reduction, that means you are improving your probability of success by greater than 50%. And that is the very key point that I'd like to make. If you look at the statistical analysis, if you trade small and you trade often, you do it over and over again, months after months, you will see how your portfolio will improve at a higher rate than if you just trade in stocks. It's just any statistical analysis that you will do, backtesting, you will find that. It also allows you to leverage your capital. A lot of our portfolios are, on average, retail portfolios, $10,000. If the average portfolio is $10,000, how do you buy stocks that like Priceline that trades at $1,500? That means you can only buy, one share, and that's already more than 10% of your account. So it becomes prohibitive for you to participate in great stock like Google or Priceline. So if you have an underlying options, you can always participate in these greater names because options allow you greater leverage. Options also allow you to limit your downside. The most frustrating thing as a trader, you can be correct on the direction of the market and you can be correct on the timing of the market, but short-term volatility can trigger your stop orders and you can sustain losses in your account. By trading options, it kind of limits your downside and allows you to withstand short-term volatility. You also can have unlimited upside if you trade in options. So let's go through an example. The most common example, the first thing when you try to dwell into the world of options is trading a call. What is a call? Call gives you a right to buy an underlying asset at a certain price point in the future. Think of it as you want to buy a house, and the house costs $250,000. Let's say this is an average house cost in the United States. Let's call it $250,000, but you don't really have money to buy it now. You will be able to afford it in 6 months. So you go to your landlord and you're saying, well, I can buy these options in 6 months. This is great. So this is what a call is. Call allows you to buy underlying assets in the future at the current price. So you see on your chart, this is an example of a call, where the stock appreciation of the stock, if you look at the x-axis, as stock goes up in value on the x-axis, your underlying derivative, the option, goes up in price. Some of the important things that you need to learn is strike price selection. When we talked about the price of the house, $250,000, that's what we call a strike. You also have to be correct on the expiration months. Options are derivatives. Think of them as insurance. When you buy insurance on your house, it has certain time duration. You usually buy it for a year, so options have expiration. After a year, you have to renew your insurance for the house. Same thing with the options. Options give you limited loss, unlimited gain. You also have to know what your break-even point. You see on the chart on your screen, break-even point is when the x-axis meets the y-axis and where the profit and loss chart for the call meets the x-axis. And obviously options could be directional trades, but they also can be market neutral trades. So hopefully this gives you an introduction to options and gives you, a reason to dwell into the world of options and learn more about them. Be sure to visit tradespoon.com for a free webinar. We have a lot of great content and daily webinars. Also visit our site and visit Tradespoon for social media and our daily videos. Thank you.